Well, it's time to roll time forward. 91 days has gone by. The opening quarter has been completed. The financial statements have been prepared. And it's time to take a look to see how we did in the first quarter. So please refer to the winter quarter actual results, the statement of income, and the balance sheet. Well, if we take our pro forma and we line it up next to the actual statement of income for the first quarter, we can make some observations. We may look at sales, which were forecasted to be $316,301, and we note that we were close to, a little shy of producing that level, but did generate $315,039 in sales in the first quarter at our place. Recall that the opening scenario, the marketing plan suggested that the food costs, due to the pricing decisions and the promotions associated with food, such as a 2-for-1 as an example, did produce a food cost that was pretty close to the 40% that was forecasted, 39.5. Differences in the food cost that was projected could be due to differences in the menu mix. We don't know what the popularity of these items is going to be until a certain period of time has transpired. Continuing to audit the statement of income, we find that the payroll was in fact the $93,912 that we forecasted. The direct operating expenses is a truly variable expense at our place. This is the 85 cents per food order that was allocated for napery, table decorations, menu printing, and the like, all accounts that are affiliated with the direct operating expense, music, entertainment, etc. So that's the statement of income. Our interest, however, is in, are we fulfilling the promises? So for a winter quarter review, I'd like you to compare the opening and closing balance sheets. For review, let's contrast the difference between the balance sheet and the statement of income. We have the opening day balance sheet that we constructed through the opening chronology. And we also have the ending balance sheet at the close of business at the end of the quarter. And what's responsible for changes between the opening and the closing is a function of time and what's transpired during that period of time. Part of it is the statement of income. Recall that the statement of income is a summary of activity over time. On the morning of opening day, we had 0 revenue. But at the end of that first day, we generated a certain amount of revenue and a certain amount of expenses. And over 91 days, those accounts have been totaled. You see the results in front of you on the statement of income. And we can see how the condition of the balance sheet has changed over the period of time. So the first question I would ask is, are we making good on our promises? Our private investor contributed $305,000 in order to enable us to open this restaurant. So at the end of 91 days, how do we know whether we have in fact paid the investor that portion of the principal that our loan agreement suggested needed to be repaid? Well, recall that we have 2 components to the long-term debt. We have the current portion, which is due and payable in the upcoming 12 months, and we have the remaining portion, which is due and payable at the end and later of those 12 months. So if you would, please find the current portion of the mortgage on your balance sheet. It's the lower right-hand corner. And note that it is $18,146. Then add that to the long-term portion of the mortgage, which can be located a few lines lower on the balance sheet, lower right-hand corner. The long-term portion of the mortgage is $282,783. If you sum those two together, we'll find that the total amount of the mortgage or the mortgage balance at the end of the quarter is $300,929. The sum of the current portion, that which is due and payable in the next 4 quarters, or 12 months, and that which is due and payable beyond those 12 months. The original mortgage amount was for $305,000. The balance of the mortgage at the end of the quarter is $300,929, less than it was at the beginning of the quarter. Therefore, the balance sheet indicates that clearly we have made good on our promise to the private investor in the first quarter. We can also audit the lease by adding the current portion of the lease to the long-term portion of the lease. And in so doing, we find that the ending balance sheet value for the total indebtedness on the capitalized lease is $78,399, less than the $80,000 that we recorded on opening day. The balance sheet reflects the principal reduction associated with those loans being repaid. The statement of income records the interest associated for the use and enjoyment of other people's money on the amount that was loaned to us. And the long-term interest associated with the various loans that were secured to open our place, you might note, was $11,813. The income statement review. We might ask, how's business? And one of the ways to maintain an analysis of how's business is to maintain some type of a document that tracks important metrics or trends that are associated with your enterprise. And at our place for the first quarter, we have updated a measures of productivity form that we'd like you to refer to. Here on our measures of productivity, or a trend tracking document, if you will, we're recording some of the metrics that we may feel are important to our enterprise. For example, food sales, beverage sales, and total sales. We can look at the winter quarter forecast. Total sales, if you recall, were forecasted at $316,301. We enter the winter quarter actual total sales of $315,039. And the percentage relationship between them is that our forecast was pretty accurate. Sales are a little bit lower. They're 0.4% less than what we forecasted. Whatever metrics management wishes to maintain, the benchmarks by which we analyze our business on a month-to-month or quarterly basis, whatever your accounting cycle happens to be, is an important aspect of management's responsibility. The attributes or benchmarks that we have listed on our trend tracking table here are not absolute. They are just a beginning to get us started in recording some of the important information about the operation at our place and how it may be changing over time. Well, so far we've introduced 2 of the accounting statements or financial statements in business, the balance sheet and the statement of income. We've looked at the forecast, the opening day, and the end of the first quarter, and it's time to gravitate towards what might be perhaps considered to be the most important financial statement in business, which is the statement of cash flow. And many of you have probably heard the old joke, how do you make a small fortune in any business? Well, we start with a large one. What's the formula for survival in business? Well, the formula for survival is the following. Cash flow is equal to or greater than 0. If your total cash flow is equal to or greater than 0, you will survive, which is why many consider it to be probably the most important financial statement of the 3 that we're going to discuss today. And it's very important to understand that profits do not equal cash. Many people look at the restaurant industry and the profit as a percentage of sales and get quite distressed compared to perhaps other industries. And it's important that we don't confuse profits with cash for the following reasons. Profits don't equal cash perhaps due to the accounting system that your business is using. Most businesses will use an accrual form of accounting versus a cash accounting system. The best example I can give you of that would be something like, how would you handle property taxes? The property tax bill might come to you in January. It's due and payable at the city clerk's office by the end of the month. And if that dollar amount were, say, $36,000, well, the check was written in January for $36,000. But due to something called the matching principle in accounting, the restaurant is able to generate revenues over the course of the entire year that should be matched against that property tax payment that was made in January. So the way that's handled is, at our place, if we're using a quarterly reporting cycle in accounting, we would put 1/4 of that $36,000, $9,000, on each quarter's financial statements to satisfy the matching principle in accounting. However, all the cash actually flowed out of the cash account in January. Most businesses use accrual accounting. There are also revenue reasons, however, that also explain why profits don't equal cash. The best example I can give you there is probably accounts receivable. In the late 60s, early 70s, when some of you may have been operating restaurants or working in restaurants, credit cards were a fairly new phenomenon. And at my parents' restaurant out on Eastern Long Island, we would take those credit card vouchers to the bank, and 7 to 10 days later, the cash associated with those transactions would be placed into our account. Over the course of time and advancements in technology, most of those credit card transactions that occur in our restaurants today are considered to be a cash equivalent due to the speed with which those transactions are made. However, you may be engaged in some catering that you in fact do bill out at the end of your weekly or perhaps monthly accounting cycle, so you may have posted some sales on your statement of income for which you have not yet received the cash until that receivable has been come in. There are also expense reasons, other than how we handled the property tax in the accrual system of accounting explained earlier. By this I mean, we have certain expenses on our statement of income, or we may have, that are called non-cash expenses. A good example of a non-cash expense would be depreciation. At our place, for example, if you look at the first quarter's results, or for that matter the pro forma, you'll see that the depreciation was $6,750. That entry did not require any outflow of cash. Okay, depreciation is allowed by the government under the rules established for various classes of assets, and the theory on depreciation is the government wishes to enable business people to be productive over the long term. Because if you're productive in business over the long term, we will continue to pay taxes to the government over the long term. And to incentivize the business person to do so, or to enable them to be, they recognize that over time, money needs to be put back into the operation in order to continually renew it. Furniture and fixtures do wear out. The rug may need to be replaced. Additional kitchen equipment may need to be purchased in order to continue the revenue growth in our establishment. So the theory on depreciation is that that $6,750 is squirreled away, if you will, into a reserve for replacement account for the future replenishment of those equipments and furniture and fixtures in the entity. The reality in most small business, however, is that that depreciation is necessary for the operation to survive. And at our place, we have two non-cash expenses on our statement of income. One of them is depreciation, and the other one is the amortization of the capitalized lease. You might note that we have a $2,500 expense in the occupation cost category of the statement of income, which is the rational discharge of the capitalized lease that we're carrying on our books. The initial book value was $80,000.